A venture capital fund invests in private companies in return for equity. These companies generally have limited operating history and are too small to raise capital in the public market or secure a bank loan. However, these companies have path-breaking technology and/or have tremendous growth opportunity. Venture capitalists take the risk of investing in these companies by the way of ownership. They nurture, help them grow and most often attain an exit by taking them public or via sale of the company. The high risk they took betting on these companies yields higher returns. If you compare S&P returns to the US Venture Capital Index, you will see historically not only did venture capital outperform S&P 500, they also have an inverse relationship. So what does that mean? For example, your traditional portfolio consists of 70% stocks, 20% bonds, and 10% money market investments. With the new addition of venture capital, your portfolio can now be 60% stocks, 20% bonds, 10% money market investments and 10% venture capital. The addition of venture capital will not only diversify your investments, it will also help you mitigate the risk given the inverse correlationship between S&P 500 and the US venture capital. For the first half of the 20th century, venture capital was the domain of the wealthy individuals and family. NIN.VC is a first-of-its-kind attempt to bring venture capital to everyone. With a minimum investment of $100,000, you too can be an investor in venture capital. NIN.VC is your gateway to a new asset class, venture capital. Every year, nearly 2 million businesses are created in the United States, and 600 to 800 get venture capital funding. According to National Venture Capital Association, 11% of the private sector jobs come from venture-backed companies, and venture-backed revenue accounts for 21% of U.S. GDP. So let's commit to venture capital and promote entrepreneurship and jobs for United States.
VC investing has risks associated with it. Past performance does not guarantee future results.